Thank you so much. And we had a fantastic 2 sessions prior to that. And Edward's a great host. And let me try to get the best out of these very distinguished panelists I have. So far, we've been talking about REITs from a little bit of a higher level. But now we've actually got 2 out of my 3 panelists are actually running REITs. So we can hear it straight from the horse's mouth. So what I would like to do first, just so that you get familiar, is for each of you to please introduce yourselves very briefly and what brings you to this symposium.
Good morning, everyone. Thank you, Nupur, for the introduction. So I'm Han Kim Siew. I'm the CEO of OUE REIT. We are a pure 100% Singapore REIT with 3 office assets, 2 hotels, the Hilton and the Crown Plaza at the Terminal 3, and also the Mandarin Gallery. So our AUM is around 6 billion. Thank you.
Hi, good morning. Good to be back at this year's annual symposium. My name is Russell Ng. I'm the REIT CEO for AIMS APAC REIT. We are an industrial REIT focused on industrial properties such as data centers, advanced manufacturing, food facilities. We manage logistics and warehouse properties, high tech that is leased to life sciences, and also business park assets that are also leased to telecommunications and food and consumer staples. We're very much focused on on Australia and Singapore. Our head office is based in Sydney. Australia is about 30% of our portfolio income, 70% is in Singapore. And our Singapore portfolio really represents 25 properties. Australian properties are really 3 master tenanted buildings on long-term leases. From an AUM perspective, we're over 2.2 billion in terms of total assets. Thanks.
Jin Cheong?
Hi, good morning. Thank you, Nupru. So I'm Jun Chong. I'm actually part of the Mumu team. So I do hope that a lot of the audience today members, you are actually using Mumu. So that's why I'm here today as well. Yeah, I think that's really more from me.
Okay, so we're going to hear your insights. This topic is investing in Singapore REITs. So sometimes there's a bit of confusion. All the REITs listed in Singapore are Singapore REITs, but what we're trying to say in this panel is the REITs which have predominantly Singapore properties. So that's what we have here, and that's what we're going to discuss. So I'll ask the first question to you, Jin Cheong. Amongst all the 40 or so REITs that we have listed here, are there particular segments that you think are particularly undervalued or overvalued?
Valuation-wise, I think for a lot of investors here, even audience members today, you're probably going to look at price-to-book ratio, gearing ratio, etc. I think the REITs Symposium today had a really great glossary. So if you have no idea what I'm saying, you can just look at the table at the back. So those are really good data points. So yes, a lot of REITs today are priced very attractively. So are there any REITs that is overlooked or undervalued? This can be different for each individual investors, what you are looking at. Of course, I think today's panel, a lot of people are talking about your interest rates, your geopolitical situation, your macroeconomic different situation. However, for us, I thought it would be a really good way for me to share with everyone on maybe overlooked or undervalued REITs in Singapore by using some data points from Mumu, because we are one of the, I guess, big players in Singapore. So I just use a data point to just compare between last year and this year. How many investors are actually purchasing more REITs in different sectors? And then the change in total number of shares, really, the top one is actually data and infrastructure. So that is going a lot. And the one that has improved the least is actually retail. So is this a way you can see that maybe retail is maybe more underlooked or undervalued by retail investors today? Of course, there are things like your e-commerce coming in. There's your things like maybe lesser people are working in offices. They are working from home. So maybe retail REITs are not as attractive to a lot of individuals. Or maybe it could be COVID fatigue. So there are lesser participants in the retail REIT sector. However, if investors were to look at it, share price-wise, it's going well. Using my data point from a year ago. So all of these REITs are doing better and better last year. Everyone went up from the data point I took in. So if I were to say, is there a particular sector per se that is being overlooked? Maybe retail. Some investors may look into it. What is doing really well? Your infrastructure and data center. Are investors more into data and infrastructure because, let's say, we have the US tech giants doing really well. We have your AI coming in. So more people are investing into it. So yeah, I guess from our angle in Mumu, this would be just some of the things that investors are looking more towards and maybe looking less towards.
Okay, so you see, at least on the REITs or real estate, you see more on retail from where you sit. Okay, so I will move to ask maybe the first question to Han. OUE REIT has properties in both hospitality as well as retail, office. So can you share with us, office, there's always been, I think we're out of the COVID, people are coming back, and hospitality, we just heard from the previous panel about ultra-lux hospitality seeing a lot of demand, but maybe you can share with us in the office and hospitality properties that you own within OUE REIT, what do you see, how do you see the demand from the tenants?
So with regards to office and sort of your early comments on what are the loved and sort of unloved sector. So I've just been back from Bangkok last week, and then earlier this week I was actually in Tokyo. So for the first time, I have to say, there was actually a lot of interest in our REIT because we have prime grade A office buildings in Singapore. So we have OUE Bayfront, which is right in front of Fullerton Bay Hotel. We have the One Raffles Place, 2 towers on top of the MRT station, and the OUE Downtown, which is next to the Singapore Stock Exchange on Shenton Way. And together with our 2 hotels, the Hilton which used to be the old Mandarin on Orchard, and also our Crown Plaza, there was actually a lot of interest in both Thailand and Japanese investors. It was very different as we were coming out of COVID. In 2022, when we spoke to investors, most didn't want to speak to us. They were like, oh, office, no one's coming back to work, so office must be very bad. But today, we track the footfall in One Raffles Place. Since last year, the footfall has been 106% today compared to 2019, which means there's 6% more people coming back to work than there was in 2019. So the investors are starting to pick up and say, hey, it looks quite interesting. They ask about the work from home. We say, actually, Singapore, most people do 3-4 days work from home, but in terms of what's happening with the office space, a lot of the financial institutions, the banks, they did the right sizing, which means they cut the space down to 60% of the people in terms of capacity back in 2020, 2021. So today, when they ask people to come back to work, you actually don't have enough seat. Then the problem is the staff start booking meeting rooms. Then they cannot have they don't have enough space for meeting rooms. So we're seeing that happen a lot. And similarly, for hotels, as we were during COVID, as you know, hotels was a very bad business. It's 2021. I think we're down to 200,000 visitor arrivals compared to last year was 16 million visitor arrivals. Before COVID, 2019, it was 90 million. So it was very bad. So as we're coming out of COVID, again, a lot of investors say, hotels, don't talk to us, please. We think hotels are very bad. So, but now actually, especially in Japan, because the room rates in Japan are going crazy. The last 3 months they've actually gone up 50%. In all across the different segments. So the Japanese investors are very interested because they see that can happen in Singapore. Singapore is starting to happen. So Singapore hospitality has actually recovered since 2022. 2023, I would say, was probably the best year in terms of the growth. Last year was very good in the first half. The second half was weaker. First half because in the first quarter there was the 10 concerts of Coldplay. There was Taylor Swift. The impact of Taylor Swift was basically like a Formula One event. I mean, that is how strong this Taylor Swift, the performance was in terms of drawing the crowd, generating the growth in the economy during the time she was here. But obviously, it started slowing down a bit last year. And this year, actually, revenue for all hotels in Singapore would be down because the base was very, very high last year. There was a Singapore Air Show, there was a lot of concerts. But this year, the first quarter, no concerts. This year, January, February was quite strong, but March, we saw actually there was a dip. And we believe that that's a lot tied up with what's happening with the tariffs war in generated by Trump, etc. So slowdown in visitor arrivals. But we believe this tariff thing in the short term, yes, there'll be impact, but over the medium and longer term, hotels will continue to do well. Southeast Asia has 650 million people. China, India, if you throw it all together, that's 3 billion people. And it's a middle class which is growing. So we want to be in the hospitality segment. It's 35% of our revenue. We do believe it will continue to grow on a macro level. So short-term volatility, that is to be expected.
That's great. So I think what I heard is you're feeling more loved.
Yes.
Which is also
a lot more interest now, yeah.
A lot more interest, which also is similar to what Ben's point from SIAS in the last panel discussion, where he said that the real estate goes through cycles, and the market goes through cycles. And if certain sectors are down one day, you just wait long enough, and they'll find their day in the sun. So hopefully your sectors are coming back. So over to you, Russell. Your properties are quite different, industrial and logistics. I think 70% Singapore, 30% Australia. Can you give us, again, an understanding of on the demand side from the tenants, what are you seeing?
Sure. Okay, so I think for the industrial sector, there's quite a number of key drivers that we think are sustaining good demand for industrial space, advanced manufacturing, warehousing space. I think the first thing is really supply chain resilience. This hasn't been a trend that just started with the start of this tariff war. It started right after COVID, right? I think the US realized that a lot of their medical supplies and a lot of their access to key materials were fairly limited. And so from 2020 onwards to 2021, you started to see a shift gradually, really from a China plus one strategy. And so Southeast Asia were a key beneficiary, of which Singapore sits right at the heart of that. And so Singapore is not a low-cost manufacturing base. In fact, it's quite expensive, but it has managed to attract significant capital to this part of the world. It's seen as a reliable, trusted partner. It's got very established pro-business policies. It's got a very strong ecosystem across various industries, be it from semicon, from life sciences, pharma, aerospace even. And so that's really sort of underpinned that shift. Singapore also has very strong IP protection, and that's crucial for industries like high tech, semiconductors. That's what's really sort of driving a lot of the underlying demand and the flow through impact in terms of storage, distribution, and also having distribution of input materials within the ecosystem for some of these global MNCs. The other thing that we've also seen through this whole tariff episode is, if you've seen the headline tariff rates, Singapore's been lucky. Their base rate is 10%. Our neighbours, I think Vietnam is 46%. If you look at Indonesia, it's about 32%. Thailand's 36%. Malaysia's 24%. And so what you are seeing is Singapore essentially being a re-export hub. And I think a lot of global MNCs see that, and so they are shifting a lot of their operations over to Singapore. And I think we've not only seen that from global MNCs, but also from Singapore customers. And so we have an advanced manufacturing customer of ours, and so he has, I think, over 100 employees and 2 factories in China. He will, manufacture the raw materials out of China, ship it over to Singapore. They will assemble it and basically export the components for chips over to the US. So clearly that benefit's also coming through. And I think that the last point is, if you look at where the current sort of industry is going, Singapore is right at the heart of the region, where it's attracted almost 25 billion in terms of investment for semiconductors over the last 2 or 3 years. That's 25 billion US. Companies like Pfizer, companies like Moderna have invested $2.5 billion of committed investments over the next 2 years, building manufacturing plants for cancer and antibody drugs. There have been over 5 vaccine facilities that were built over the past 5 years. And so if we look at the trend of foreign direct investment in terms of fixed infrastructure for industrial, that trend is actually increasing on a year-on-year basis. 2022, we had about 22 billion, which is a record year. On average, it's typically 10 billion. The last 2 years, we've seen about $13 billion invested each year. And so that's really the under sort of pinnings of the drivers of industrial. And certainly for us, across our portfolio, we do benefit from those particular trade flows.
Okay, that's, I think Singapore being a kind of a stable place in an uncertain world is probably helping from the industrial perspective. Maybe ask to you, Han, what are some of the secular and cyclical trends that you are seeing that we may not be fully appreciating? So I think tariffs is one. Does that affect your sector, and how does it? And what are the others?
So with regards to tariff, as of today, we actually haven't had tenants come to us and say, hey, can we give space back? Can we leave because of the tariff? No, we have not seen that, zero. We're still seeing new businesses opening. We're still seeing some businesses expanding. So it's we don't really see that effect. I think a lot of businesses take a longer term view as opposed to reacting to what Trump says or to what the market says on a daily basis, because it's not possible to plan a business by listening to what Trump is saying or the other leaders are saying with regards to tariffs. So businesses take a longer term view. In terms of Singapore office market for the CBD is actually very tight. So our portfolio, the occupancy is 96%. The market CBD in the grade A space, it's 94%. So if you look going forward in the CBD, this year, next year, and following until 2027, there's zero supply. No supply in the office market. It's only coming up in 2028 or 2029, depending on when the latest sort of, or the next one coming up will be completed. So there's no supply. Demand, you can say demand may be strong, may be weak, but if there's no supply, there's no pressure actually on rents, and there's no pressure for landlords to actually drop rents. And if businesses, they want to be in the CBD, because I'm sure some of you have faced it. Recruitment is very hard. When you hire young people, it's very hard. And they want to be in the nice buildings, they want to be in the CBD, they want to take an MRT, which is connected to the office. They want a bus, which is sheltered, connected. They don't want to have to walk in the rain or the sun. They want to be where the facilities are. So there's a lot of requests. So because businesses in Singapore are fighting to recruit talent, to recruit people, they have to be in the CBD. Otherwise, the young don't want to work for them. That's quite simple. So being in the CBD matters. We feel that there will be a bifurcation. What that means is the best office assets, the grade A in the CBD, will outperform the ones which are grade B. You will see that happening. It's not just Singapore. When we were in Tokyo, we asked, same thing happening. One of the investors shared with us a very large conglomerate actually moved out 45 minutes out of Tokyo about 10 years ago. They've moved the whole business back into Tokyo again, into Nihonbashi, which is in the center of the city again. So again, the problem is trying to hire talent. Talent wants to be inside. If you tell them to work not in the CBD, they'll say, it's okay, I'll work from home. So how do you get them back to work? You have to be in the CBD. We believe we'll benefit from that trend. But it's quite important. Offices have that as well. Singapore, we're in the hospitality, in the retail segment. The tourists have shifted in terms of their spending patterns, especially the Chinese. They no longer go for the big, loud, shopping luxury brands as much anymore. So we've seen their spending on that has halved in Singapore. What has replaced their spending is they spend a little bit more on accommodation. They spend a lot more on food, F&B. They spend a lot more on experiences. So that's what they're spending on. So this this trend will be here to stay. They're spending more on healthcare, on beauty and wellness. So that is the trend. So for the Mandarin Gallery, we've always had that beauty and wellness. So we're increasing that a little bit more. So anything Korean actually is super trendy right now. So we have a ginseng restaurant, ginseng chicken Korean restaurant. The team and I, we tried to get a booking for 3 months. We couldn't actually get a booking, and the queue is like an hour and a half to have ginseng chicken. But it's very popular because it was from Korea. So these are the trends we're seeing. Anything Korea now, I think coming up also, you'll see increasingly more. Anything Japan will actually be quite popular. A lot of Singaporeans travel to Japan, come back, they're quite familiar, they understand there's a quality, and they appreciate it. So we believe that's a trend that actually has changed. So it's very important to pivot to that. Singapore also has gotten quite expensive. Food is quite expensive, hotels quite expensive. So losing some of the incentive groups which are coming through, they're going to KL, they're going to Bangkok because it's much cheaper and there's different categories. So Singapore has to pivot and Singapore has to move in the right sort of direction. But the government has done quite a good job. If you look at family offices in Singapore, in 2017, the number is there was 100 family office in Singapore. In 2024, the number is 2,000 family office. So 100 to 2,000 from 2017 to 2024. So with the family offices coming in, Singapore is getting a lot of investable assets being deployed in Singapore. A lot of professionals are coming to be based out of Singapore as well. So it's a changing profile. Singapore now has a large concentration of pension funds. A lot of the North American pension funds actually opened a base or relocated out of North Asia into Singapore over the last few years. So Singapore is growing and it's changing. The profile of visitors are changing as well.
That's great. So can I ask on the retail side, what's the numbers for the Chinese tourists? Are we back to the pre-pandemic or not yet?
The Chinese tourists are circa sort of 85% of pre-pandemic for our hotel. Actually, it has doubled. Because again of the location, they like the Hilton where it is because it's convenient, etc. So they like the Crowne Plaza. So a lot of the Chinese come and they'll stay 2 nights. So when we ask them, they say many times they pick the Crowne Plaza as one of the nights, so the night before they leave, because they like the Jewel. The Jewel is a very interesting shopping experience for them. So they'll check in there, they'll take the family, eat, shop, and then spend some time, and then they'll fly out the next day. So the Jewel is actually becoming a destination for them. Yeah.
It's interesting. Maybe Jun Cheong to you. So we hear all these metrics from the CEOs, but from your broker perspective, what are those indicators that you look at, or which is to determine the stability or the growth potential of the REIT? Anything that you monitor at your end?
I guess for a lot of REIT investors, what they would really look at for indicators would be definitely dividend yield, as well as your DPU growth. So these are 2 things that a lot of investors will look at. You're not looking for, of course, price appreciation is a bonus, but you're probably not looking for that, because if you're going for that, you'll probably go for value stocks or growth stocks instead. So what you're really looking for is DPU growth as well as DPU yield and price stability. So these are the things that really help investors. So I wouldn't call it an indicator, but it's an important thing for investors to also know is, of course, what we like to call currency risk. So when you're looking to invest into any investments, it could be REITs, it could be anything, you want to look at the final currency that you want. So we're all here in Singapore. Let's say, for instance, REITs, you are going to be paid in Singapore dollars. That is where you want to see, okay, it's my REIT, are they based, let's say, for instance, in a huge percentage of the REITs, the properties, the revenue, etc., they are based in overseas. So that is also one thing that investors want to take note of, because ultimately, for every investor here today, you are going to receive Singapore dollars into your bank account. You want to spend that Singapore dollars. So that's one currency risk that all investors should take note of. And that also brings to the same point with stability. So that brings stability to all investors. And of course, there are different indicators in terms of stability. So for instance, we can look at your gearing ratio. Is the REIT more resilient than others? Are they good at managing their debts? And then I think from both CEO today, there's one very important thing. It's also occupancy rates. So you want the occupancy rate for your REITs to be good, because ultimately that's where, for investors, I'm going to speak from a point of investors, your dividend comes in. So as long as the REIT has good occupancy rate, typically we like to look at it at 95%. Good occupancy rate has good pricing power. Tenant demands are there. That's very good for all these individual REITs, and it's good for investors as well, because the money is coming in, they actually paid out to you as investors, and then I guess these are really the few indicators I will look at. So really just DPU growth, from a stability point of view, look at gearing ratio, look at occupancy, and of course, in a way, bring in currency into your stability part. It can go both sides for each individual investor.
Thanks. So for REITs which have predominantly Singapore assets, at least the currency part is a bit lower or not there. So just picking on the point of DPU stability and DPU growth, maybe if I can ask you, Russell, I think AIMS APAC REIT has been particularly active successfully in asset enhancements and redevelopments of your portfolio to unlock long-term value. Can you explain what is the thought process, how do you go about it, and how does it actually help unit holders?
Thanks, Nipur. I think this is really one of our key strategies for AIMS. Really, over the past more than a decade, we've undertaken 5 asset enhancements. So these are major projects where we either increase floor area, rejuvenate, reposition buildings. We've also undertaken 6 redevelopments. So we've knocked down properties and put it from the ground up. And these are typically ramp-up logistics warehouses, which have done really well. Actually, most of our ramp-up properties post-construction have almost been fully occupied since it was built. Tenants like the fact that you have direct access to their loading bays on different floors. So it's really just a function of pricing, but it's always been pretty well occupied. But how do we create value? It's really through a combination of up-speccing the specifications, either through the hardware, because it could be external panels, this could be the M&E equipment, or it could be the software. It's the look and feel. When tenants come in, are they walking into an industrial building, or are they walking into a property that has more of an office look and feel in the lobby? Why? Because a lot of these customers will have their own end customers visit them at the offices. And so the profiling of the properties is very important in order to really attract the right sort of quality tenants that we're typically looking for. And so really off the back of just the upgrading component, the second element in terms of where we create value is finding these world-class investment-grade tenants. These are the guys that pay the rentals that then underpin the distributions. And so if you look across our portfolio, we have almost 80% of our tenants in what we call defensive industries to leading corporates in the industry. So we have Woolworths as a top tenant. Everybody knows Woolworths, top 10 ASX listed company. Optus, which is a subsidiary of Singtel, so a very strong covenant. We've got companies like, in the past, DHL, Schenker. These are global 3PL players. Companies like ResMed, a leader in sleep apnea devices. They own 60% market share. They're a $30 billion market cap business. So very stable operating performance, very strong fundamentals. Through a company like Illumina, which is a leading DNA testing provider. They look at whether it's COVID or cancers. And so that's a big part of, so Singapore's a big part of the operations. And so when you look at not only attracting these type of profile tenants, you're able to then secure a long-term lease. So tenants, before they lock in a 10-year lease, will want to ensure that the property is of a certain quality because they also have their own occupational requirements. And so we create value by not only then upgrading, securing tenants on long-term leases. The next step is actually getting, hopefully higher rental rates, right? That have rental escalations. And so if you do it right, and you really sort of create the right sort of repositioning strategy, you do get tenants that will lock in 10, 15-year leases, and that's what's really underpinned the performance of our portfolio, because you not only get higher rental yields, but you also get what we call cap rate compression. So cap rate compression, the lower the cap rate, the higher the valuation. And so what does cap rate represent? It looks at the overall risk profile and the income profile of that asset. That's what creates the value. Now, from our perspective, we're also undertaking 2 asset enhancement projects currently. Our first project is really a repositioning of an old warehouse leased to 5 tenants. We vacated the property. We're upgrading it to a Green Mark Gold certified building. So it's empty at the moment. It's been empty for the last 6 months. But on completion, the property will be leased to a global storage company for 15 years with a 2% escalation every year. And not only are we getting that high-quality tenant moving into the building, we're getting a much higher rental rate. So the property yield before the exercise was sub 5%. We're hoping to get close to over 7.5% and upwards from day one. And that yield will continue to grow every year for the next 15 years. Our second project, it's a repositioning of an older industrial warehouse. We're looking to pivot to more of a high-tech user base. So we vacated some of the old industrial users, and we just did some light touches, changed the lobby, really sort of transform the overall experience, even the landscaping, the external. We reskinned the facade. It didn't cost a lot of money. But through that whole feasibility analysis and exercise, we managed to secure a Temasek-linked company in advanced manufacturing. So that's really sort of working towards our strategy of getting high-tech users. And so they've agreed to lease that property for 10 years, also with rental escalations, and on a rental rate that's 25% higher than the previous rental rate. So it's really through these type of strategies that we're able to really underpin the portfolio performance. And so over the last 5 years, our portfolio occupancy has been tracking roughly between 96 to 98% on an adjusted basis, taking into account committed leases. We've managed to really drive strong rental reversions, starting in 2022 at 8%, then 18% the following year, then 24%, and most recently 20%. Whilst also keeping our portfolio well between 4 to 5 years, which really sort of underpins that resilience of the overall distributions. So look, that's how we create value. It's really through a real active exercise in terms of looking at individual assets, but collectively, it does sort of provide that resilience for the portfolio.
Yeah, that's brilliant. So that's you must be very. It's a lot of hard work to produce numbers like that. So, if I can summarize what I understood you to say, so. Asset enhancements and redevelopments allow you to increase the specifications of your properties, which allow you to get higher quality tenants, which allows you to pay you higher rents, who also are willing to lock in leases for longer terms, which gives stability, and the higher rents give you all the wonderful rent reversions. So
exactly.
It's a brilliant strategy, and you've been doing very well. So moving to you, Han, we've been talking about the demand side and creating, lasting value. Just a little bit on the cost side. So we've seen over the last few years, of course, interest costs have gone up. Operating costs, electricity and stuff has gone up. So number one, where are we? I think we've heard from previous panels that probably we've peaked on the interest cost side, but I'd like to hear your views. And secondly, on the operating costs, where are we? Is it going up in Singapore, going down, and how are you managing it?
So touching on interest rates. So interest rates, we can see the base rates, SORA, has actually dropped nearly 100 basis points, so nearly 1% since September last year to today. So that is quite significant savings there for all the REITs, actually. So the cost component, one of the largest cost component for REITs is interest rates. So this basically you're seeing across the board for REITs which are raising financing in Singapore, you will see that 100 basis point saving for the unhedged portion. So for instance, for us, we are hedged 75%. So the unhedged portion, 25%, we will automatically see 100 basis point saving in that period. We do think the trajectory is going down. Currently, our cost of debt is 4.2%. Now, if we were to go and tap the bond market and issue new bonds, a 5-year bond, based on where our secondary pricing is trading at, would be circa 3.5%. So quite different from the 4.2 average which we have today. Obviously, we do believe going forwards, as long as base rates stay at this level or they do come down over the next 1 year, then there will be interest savings for us and across the board for the REIT sector as well. So that is one of the key drivers in why or how dividends or DPU will grow over the next 12, 18 months. So we've done a lot of work on that over the last 3 years when during COVID period, as we're coming out, there wasn't much you could buy, there wasn't much you could really sell because market was quite bad. So we did a lot of work on the capital structure. So during that period, we did a lot of refinancing. We moved a lot of our debt from secured to unsecured. We basically moved when we started the journey in 2022, 10% of our debt was bonds and 90% was banks. Today, it is 40% bonds and 60% bank. So it's quite a healthy balance now. Bonds basically allow us to tap the market for longer debt, which is 7 years and potentially 10 years. But to do that, we needed to get an investment grade rating, which we were able to achieve towards the end of 2023. So we did 3 bonds, investment grade bonds last year, which means investors can actually, institutional investors can start participating. Institutional investors pay a little bit more attention to the quality of the asset, the quality of the earnings, as opposed to retail investors. So if you don't have an investment grade rating in Singapore, normally when you issue a bond, it will go to private banks. And private banks the investors from private banks have a certain number in their head. And that number is always quite sticky, whether it's 5%, 4.5%, 4%, it's quite sticky. And that is correlated with where the T-bills are. If T-bills are paying 4%, then we say, hey, our bonds are 4%. They'll say, no, 4% is too cheap. You must give me at least 5%. So that's how actually private banks look at it. So when we started that journey, we did a bond in May 2022. More than 90% was private banks. Clients. When we did our 7-year bond last year, the last one in November, it was basically over 99% was institutional investors, and they paid, and were able to do a 7-year at 3.78%. So having institutional investors, actually having investment grade rating does allow us to really enjoy the savings, because institutional investors are not so sticky. They look at actually, investment grade, then they will price it differently. So, but on a sort of macro level, all the REITs will benefit from this declining trend. Yeah.
Congratulations on your investment grade rating.
Thank you.
So you heard that as long as base rates remain where they are, I think OUE REIT is, much like I suppose many other REITs, can probably expect the interest expense line on the REIT's income statement to go down. So expenses will reduce, and the savings are usually just passed on to unit holders. So you should all benefit. So that's why right from the start of this thing, we had been talking about interest rates. They really play a pretty pivotal role. Maybe just to wrap it up, we have just time for one last question. If I can just do one round, starting with Jun Cheong. I know we live in very uncertain times. Probably if you look at our phone, there'll be some new news, but it's still night in America, so maybe not. But looking 6 to 12 months, what are the key macro trends, key indicators that will meaningfully impact the REIT sector?
Of course, I guess today a lot of panelists will be talking about definitely will be tariffs, and in the lighter term, Mr. Donald Trump. So a lot of, I guess not just for the REITs market, the market overall, a lot of things is being impacted by, essentially you can say one man at this moment. For those who have been following the news, he did actually threaten to increase 50% tariffs for EU. So these are things that can affect investors as a whole. And I think investors should continue to always be up to date to a lot of this news, and then from there you can protect yourself in times of economic uncertainty.
Russell, from your side, what do you think are key things which could impact your REIT positively or negatively?
Okay, I think a couple of things. Probably from the REIT perspective, our gearing is currently at under 30% for the last financial year. So we're very lowly geared. That gives us a very nice headroom to go and pursue hopefully very accretive deals because you've got a declining rate environment, makes it very attractive for acquisitions. So for us as a REIT, that will be a target for this financial year. The other thing I would say is, to look through the short-term noise and volatility from the trade tariffs. Tomorrow, that might be another flare-up. Everyone's friends again. It flares up again in 6 months. So cut through the noise. When you look over the long term, actually a lot of these headwinds become, I guess, tailwinds because you see the structural shift take place. Singapore is seen as a relative safe haven, reliable partner for governments and companies around the world. And that structural shift is certainly supporting the industrial market. And I think for us, more from an industrial point of view as well, keep a look at headline occupancy levels. I think Singapore industrials had almost 17 quarters of consecutive growth in terms of rental growth, and that's led to a record occupancy level around 90%. So if industrial landlords can generally hold that level of occupancy, that should be able to command hopefully some continued rental reversions. And we think, given what's happening with the supply chain reconfiguration, we've seen continued investments by global companies. We've seen just-in-time inventory stockpiling take place ahead of all these tariff shifts. That was all going to bode well for the economy. And I think just in one more point that I heard just the other day at one of the conferences, I think it may have been talked about earlier. There's a lot of capital now sitting on the sidelines, parked in cash and T-bills and bonds. Most of them were probably done at about 3 to 4%. And so in a declining rate environment, when if you see these T-bonds gets reset to a lower level around 2 to 2.5%, you will see that at least part of that will likely be rotated back into REITs, which should benefit hopefully all of us.
Yeah, that's what we are hoping for, that in this reallocation of investment portfolios by both retail and institutional investors, REITs with their relatively 6 to 7% attractive dividend yields will see some inflows coming through. Han, you get to have the last word. What, in your view, are the key things to watch out for which will meaningfully impact your REIT in the next 6 to 12 months?
So we are fortunate. We are 100% Singapore, and all our assets are in prime locations. So that is one theme which we believe in. We believe in having the best quality asset possible, because in times of stress, we do believe there'll be a flight to quality. So occupancy holds up when times are bad, and we're able to push our room rates or our rental rates up when times are actually improving very quickly. So for our portfolio, for office, we've had 8 consecutive quarters for every single office building of positive rent reversion, which means it has grown for the last 8 quarters. And with very little supply coming forward, we do believe we should continue to enjoy growth in the office segment. Again, Singapore is viewed by global investors as a very safe haven, as a very safe market, a safe haven. So Singapore will continue to outperform and will continue to do well because, again, Singapore, stands out. Its passport is #1 in terms of the best to travel with. So a lot of investors really like Singapore. They like to park the money where it's safe. Russell mentioned governance, rule of law. So all that's in place in Singapore. So that's a huge benefit. So I do believe Singapore, again, look through the short-term noise, as Russell has mentioned, Singapore will be well placed over the next 12, 18, 24 months.
Thank you. Look through the short-term noise. That's the message to take away, similar to some of the previous panels. So that's all the time we have for this panel. I'd like to thank my 3 panelists. Thank you very much for sharing. So I think now there's a break, I believe. I'll hand over to Edward to take us through the next part. But thank you so much for listening.
Thank you very much to our moderator, Ms. Nopur Joshi, and our speakers as well, Mr. Han Kim Siew, Mr. Russell Ng, and Mr. Tu Jun Cheong.